It looks like housing prices are experiencing its biggest drop in 11 years. What's really happening in the market? Should you be worried as a homeowner or a real estate investor? That's what we're gonna find out today. Hello and welcome back to another market update episode. That's right, housing prices are going down and they're experiencing its biggest drop in prices. And not just that, it seems that in some markets, we're also experiencing a drop and run. Could that be yours? I don't know. Let's just find out today. And if you stay all the way until the end, I have a bonus tip for you that's going to prove very beneficial for your investment or even if you're planning to buy a home. So let's get started. All right, so we have our first article here by the Wall Street Journal. This is where I was able to pull the information about the home prices posting its biggest annual decline in 11 years. So as we scroll down through the episode, let's see what it has for us today, right? So home sales fell across the US in March, a sluggish start to the crucial spring selling season as higher mortgage rates squash momentum from the previous month. Why is this spring so important, you might wonder? Well, think about it this way. Spring, it's getting warm. You coming out of, all those ridiculously cold months in the winter, and your children could be on spring break, right? So it becomes easier for families to go house hunting and to do that transition because you don't have to worry about your kids. You can bring them along. And also, let's face it, it's not so cold to go out and take a look at beautiful houses, whether you're looking to rent them or to buy them. And that's why the majority of homeowners or even property investors, they try to push as much inventory as they can during the spring because they know that that's when the demand typically peaks. Why not in the summer? Because the summer gets really, really, really hot for people to even want to go out. So the spring is actually the best time. In the fall, it's kind of difficult because kids are already back in school. So that's why spring tends to be the favorite time for everyone to go house hunting. Now, back to the article. U.S. existing home sales decreased 2.4% in March from the prior month to a seasonally adjusted annual rate of 4.44 million, the National Association of Realtors said on Thursday. And March sales fell 22% from a year earlier. Now, as we scroll down the article, we will soon see the reason or the primary reason why home prices are being affected and are experiencing that big decline that we're seeing on the title of the article. So according to what we see here, the housing market slowdown is now starting to weigh on prices, which have fallen on an annual basis for 2 consecutive months for the first time in 11 years. The national median existing home price declined 0.9% in March from a year earlier to $375,700. And that was the biggest year-over-year price drop since January 2012. Wow, that was a long time ago. Now, as we continue, let's see, median prices, which aren't seasonally adjusted, were down 9.2% from a record 413,800 in June. Okay, that was the highest peak nationwide in June. And home prices in the western half of the US experienced some of the biggest gain for many years, but are now falling the fastest. This is why it's important to take articles like this with a grain of salt, because now I'm wondering, okay, are they talking about the entire nation experiencing a drop, or are they referring just to that section on the western half of the US that are dropping or driving the prices down for the entire nation? I don't know. Let's just find out. But this is the reason why it's important for you to trust but verify, right? Pay attention to what the title says, read through the article, and see what are the details really that are impacting that price drop in the US market, right? So as we move along, let's see, the US housing market has slowed dramatically in the past year as rising mortgage rates, high home prices, and persistently low inventory frustrated buyers. This is something that still continues to happen, at least in places like in New York City, where the inventory is still very low because there's not enough houses available in the area. March home sales decline don't bode well for the spring season, which is usually the most active time for home sales because families with children often want to move homes between school years. And this is something that I cover a little earlier in today's video. Now, moving along, let's see what else this article has to share with us here. The spring activity could still pick up over the next couple of months, especially if mortgage rates ease and more sellers feel comfortable listing. This is actually good news for those who were actually looking forward to put their property on the market in hopes to get a good return. So it seems like nothing is set in stone as of yet. There's still hopes that you can still, have your home prices pick up and make a decent return back, assuming the Fed it's on your side and actually it doesn't increase the rates, or at least leave them as they are over the next couple of months. Now, as we continue to move along, there's another section I wanted to highlight here. And let's see, home prices are declining the most in the West. But in other parts of the country, prices are still rising from a year earlier because inventory of homes for sale is unusually low for this time of year. This is why, once again, I mentioned earlier that it is important to trust but verify. You have to get the full-blown picture, not just simply blindly trust what you see, because sometimes the picture is not what it might seem to be. That's why you need to do the market research. You need to educate yourself to better understand what is going on. Now we're finding out that although the title was quite catchy, we're finding out that, hey, it's not all of the US that is experiencing all these declines in home prices. It seems like it's mostly happening in the West, and that there's still other places in the US and where home prices are still going up. And like I said, in New York City, this is what we get to see more and more, because what happened was that during the pandemic, a lot of people left in search for, I guess, less drama, more open space, more housing space, only to find out that they didn't like that move and they wanted to come back. And when they came back, they bumped into a big surprise. Not only rentals were up in price, but also the price of homes were up in price. And to add to the equation, you're also seeing a low inventory in the market, which lends itself for bidding wars. And that's one way to drive the prices up, because for those who can actually afford a home in New York City, they're going to do what they can to put their hands on one. And in the end, the offer that ends up winning is always the one that pays the most. And as we scroll down, I actually like this quote over here because it elaborates more on what's going on. Home prices continue to rise in regions where jobs are being added and housing is relatively affordable. Well, I'm not sure about New York City, but there's certainly jobs in here. So that's definitely a plus. And as we continue to move along, we found another piece of data. Nationally, there were 980,000 homes for sale or under contract at the end of March. That's up 1% from February and up 5.4% from March 2022, according to NAR. At the current sales pace, there was a 2.6-month supply of homes in the market at the end of March. This is very, very tight, because typically a 6-month supply of homes in the market, it's already an indicator that the market it's with low supply. So at a 2.6, we're talking about an extremely low supply, which once again, it's going to lend itself for families to go on a bidding war, and the highest price is always the one that wins. Now, as we continue with the article, we also see that the number of homes for sale, it's up from a year ago because houses are sitting on the market longer. But the number of new listings in March fell 20% from a year earlier, according to Realtor.com. Now, I want to move on to the next article that talks about the rent, right? Because that's also very important if you are in the market as an investor. And this Bloomberg article highlights that there are 10 cities in particular in the US that are experiencing a decrease in rent. And this is something that we should definitely pay attention to, because it will affect your return. It will affect your ability to be able to pay back the mortgage if you have one. So let's see, rent in the US fell last month for the first time since March 2020, when the pandemic pushed much of the world into lockdown. the median asking rent fell by 0.4% year over year to $1,937, the lowest level in 13 months, according to real estate brokerage Redfin. It's a dramatic shift from just 1 year earlier when prices surged nearly 18% and some renters were faced with bidding wars for apartments, okay? Now, this is interesting. Not only you can experience bidding wars for a home that you're planning to buy, but you can also face bidding wars even with an apartment. And this is something that happened not too long ago when people were trying to come back to New York City. Now, inflation, layoffs, and growing fears of a recession are cooling demand. And these are the cities that are actually being affected by the drop in rent. So we have Austin, Texas, experiencing a decrease of 11% in the rent, Chicago, Illinois, 9.2%, New Orleans, Louisiana, a drop of 3%, Birmingham, Alabama, a drop of 2.9%, Cincinnati, Ohio, 2.9% as well, Sacramento, California, a drop of 2.8%, Las Vegas, Nevada, 2.4%, Atlanta, Georgia, 2.3%, Phoenix, Arizona, 2.1%, and Baltimore, Maryland with a drop of 2%. Okay, now I want to move on to this article, and this is the bonus that I actually explained at the beginning of today's video. I'm not going to go into details about this because they use a lot of technicality. What I'm going to do is just to simply sum up what it talks about rather than going paragraph by paragraph. But you can find this article in the New York Post, and it's talking about the U.S. subsidizing high-risk homebuyer at the cost of those with good credit. I think this article right here, you have to take it with a grain of salt. But what I'm going to do is to do my best to recap what is going on in a way that the information, it's easier to digest for you. So a couple of months ago, I created an episode and where I was sharing that you can actually negotiate down your interest rates in your mortgage in exchange for a fee. So the article at the New York Post, it's referring to those fees, and they have a technical name, which I'm not even going to get into because to my experience, nobody uses that term in the market. So basically, when you go and you are about to close on a mortgage or when you're shopping for mortgages, let's say, for example, you get a rate of 5% over here, right? And your mortgage broker is saying, well, I can give you a mortgage of 5% with your current down payment and your existing credit score. However, if you pay $1,000, I could knock out 0.10% of your mortgage rate. And now instead of paying 5%, you're going to pay 4.9, right? So typically lenders, what they do is that they give you a range of fees that you can choose from in terms of how much you want to pay up front in order to buy down that interest rate. So this article is talking exactly about that with a twist, right? Because it seems that the Biden administration came out with a new regulation and how those fees should be treated. So it seems that some of the rules that the Biden administration came up with is now quite confusing compared to what it was before. So in short, the rates are actually going up. So you're going to have to pay more in order to buy down the interest rates in your mortgage. But the ones that actually are paying a higher down payment and the ones that have a better credit score are the ones who are going to have to pay the higher fee in comparison to those more riskier buyers. And by risky, they define it as people who have a lower down payment and a lower credit score. And so it seems that the controversy, it's going around, well, I thought that if you have more money for the down payment and a higher credit score, that you should be compensated with a better rate as opposed to those who don't have that yet. And the short answer is you're still being compensated. What changes is the fee, right? So let's say, for example, if you have a credit score of a 780, for example, and you're putting down 25% to buy your property, you're already going to be rewarded with the lowest rate possible that your profile will allow you to buy. Now, if you want to lower the interest rate a lot more, then you're going to have to pay a fee. And the fee has gone up now, which it kind of makes sense given everything that's happening with inflation and the interest rate. So in order for you to bring down your perfect rate, for example, according to current market standards of 5% down to 4.7, for example, you're going to have to pay a higher fee. right? But then you have another buyer over here who, let's say, for example, has a credit score of 680 and is only putting a 10% down. This person, it's already qualifying for a higher mortgage rate than this one over here. So let's say we said 5%. Let's say this person is going to have to pay a 6.1%. And this person, just like this one, is going to be given the option or the opportunity, depending on how you want to look at it, to buy down those rates. And this person could bring that rate down from 6.1 to 6% or to 5.9 in exchange of a fee. But the fee that this person over here with the lower credit score and the lower down payment, the fee that this person is paying is going to be lower than this person sitting over here. And that's what the big controversy is about. But in essence, you're not being penalized for having a good credit score and for coming up with a higher down payment. So don't be discouraged by what the article is saying. It will probably go around on the street and you're probably going to hear about it, but that's in essence what it means. And I guess what the Biden administration is trying to do is to create affordability for those who cannot negotiate or for those who are having a harder time negotiating those rate downs. I'm not saying for or against. It is what it is. We're just going to have to adjust and live with it. But in terms of the increase on the fees that you're going to have to pay, I chose to look at it as, hey, it's something that was coming anyways. And maybe they use this as a way to, I don't know, market it in a way that it's better. But I mean, everything is getting more expensive nowadays. So it's only a matter of time that the fees will go up. So hopefully this helped you clarify some of the doubts that you have, and I'll see you in the next video. Bye-bye.